Hello guys, welcome back to another lovely trading video. In this one we're going to be doing some in-depth stock analysis on ADOBE, ticker ADBE. Reason for this is yesterday we would have seen that it pulled back around 10%. Reason for this was Q4 earnings. But to get kind of straight into it, it did come into a good buy level. So I mean there were some others that did gap down yesterday, Nvidia being a good example. But ADOBE is one that we would consider in a low risk long area, so that's why we thought to do the analysis on this today. So as always, we will start off on a clean daily chart to see is there any gaps that need to be filled, because we can usually use these as price targets. So straight off the bat, we look for very clear ones. I mean, we will use this 630 as a high up target. But apart from that, we don't really have any clear gaps. I mean, all the way down at 420, but again, we probably won't really be looking for anything that low. So apart from that, I mean, it looks pretty much just those two levels, so quite far off from where we are right now, so we may not even end up using those as levels. Now we will go to the standard deviation chart, so we can start seeing is there any or where the buy levels are, and also areas where we start scaling out. So where we are, we did actually go off in the alerts yesterday. I think this was posted in the Discord if you were in there. But around 356, 357, 355, kind of around this area here, we came into the second deviation on the 4 hour. This was kind of our first low risk long area. Then also pushing down that bit further now at 522. So if ADOBE does continue down, which isn't actually too improbable, the reason for that is usually when you see gaps, stocks gap more than 3%. Say probably like 8 times out of 10 they do continue down, usually that day and then usually the following day. Does tend to be a pattern what you see. So if ADOBE does continue down, that next buy level that we would look to get some size in at is 522. Then after that, if we somehow break the $500 psychological level, which I would consider quite unlikely, but if it does, then we have 492, 493 is kind of that next level, and that's a very extreme 444, kind of 445. That one I definitely think is very unlikely though. So really the ones we kind of see it hitting is the one we hit yesterday, the 557 slash 555. So kind of where we are now, we would consider it a low risk long, and we'll probably get some size in. And then pushing down to 522, again quite probable that we could continue down that bit further to there. So definitely if you are looking to get in with big size, I definitely wouldn't recommend getting kind of all your size in at 556, because it could kind of continue that bit further down. Then do find it quite unlikely, but again could always happen, is a long area down at 492. Don't really see it breaking the psychological $500 level, but if it does, that would be our next level. And very unlikely, but the 445 would be that next level. Now, where would we where would we be looking to lock in profits? Now, our first price target would be just below this $600 psychological level, so around 598. But you can think of this, 595, kind of around that area is where we start looking in profits, because that's where we start seeing the pullback. Not only on the psychological $600 level will we see a pullback, but it does line up with the first deviation on the daily. So it wouldn't make it would make sense to be, if at least not locking in profits here, at least kind of moving our stock to break even, because if it comes into this level we don't really want to be taking a loss on the trade. But we then do have that kind of next, again, price target around 618. And that bit higher, we then do have the gap fill at around 630. Now, where would our final target be? Our final target would be around that 675. Reason for that is that's in the statistical mean on the daily, and statistical mean on the 4 hour is only a tiny bit above, so we'll only really be looking at the closer one, which in this case is 675. The reason we don't want to hold past the statistical mean is then it turns into a lot more of a gamble in which direction the stock will go. For example, right now the stock's down at around $560, $570. When you see a stock down at this level and below this kind of first deviation, the stock's going to try and reverse to that statistical mean. So that's how we always trade it as a proper way, is like if it's at first, second, third deviation, then we know it's going to try and push back to that statistical mean. But if the stock's already at its statistical mean, then we don't really have any idea where it's going to go, because what stocks do is they swing. So we're going to see it swing away from that statistical mean, but that could be to the upside, it could be to the downside. We don't really know. It'd probably be more of a fundamental reason for it to move. So when we get to that level, it does turn into a lot more of a gamble. So we will just be locking in, or at least I personally would not be holding anything past kind of that 670, 675 level. Now, as we can see with Adobe, we do also consider it low risk long, in the sense both on the 4-hour and the daily, the standard deviation channels are very sharply facing up. This usually does give you more confirmation because the stock overall for the past 180 days and a year has been in a strong uptrend. So that does give us some more confirmation and kind of some added confidence taking these trades along. So I hope you enjoyed the breakdown on Adobe. Hope to see you in the next one, and that's it. Peace.